Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, January 9th, 2015. I wanted to start off by wishing everybody a Happy New Year. And in this video today, I'd like to do an overview on commodities uh, throughout the remainder, through the final months in 2014. And recently, I've been harping on my theme that my expectation is that we'll see commodities outperform equities in the year 2015. In other words, through year end. Um, this will be the first part of two. I will talk on the equity markets in either some separate static post or in a video format soon. But today I just wanted to touch on commodities, starting with gold, the precious metals, and then we'll roll into some specific and general commodity indices. So what we're looking at here is a weekly chart. This is a 10-year weekly chart of gold. Looks a little bit busy. What we have here, these dotted lines are Fibonacci retracements. And let's just start where gold prices are today. This is GLD, the gold ETF. I'll take a look at spot gold here in a second. So we're trading about 117 on gold. And you can see right at about that level, 117-ish, call it. Again, weekly chart here. It's really hard to discern through this chart, especially watching on YouTube, but there are two overlapping Fibonacci retracement levels. We have the move all the way off these lows back here in 2005, from that point up to the peak in gold, the 2011 highs, and that is the 50% retracement. Overlapping that line, we had this major correction. It was a 31.5% drop in gold back in 2008 into the 2009 lows. So that's a significant low, reaction low in gold. So I had another fib line drawn off there, also to the peak, and we are at the 61.8 retracement. So these two intersecting lines, where gold's currently been trading now, we pierce slightly below. But we're still well within that level and currently trading just above it. So we have what's known as a Fibonacci support cluster there on two key Fibonacci levels, possibly more if I were to add some more here. And most importantly, as most of you know, I put a lot of weighting into divergences, especially these clear, strong divergences. We're looking at the PPO, which works similar to the MACD, better used for longer time frames, and or prices, stocks or securities with relatively large price movements on the scale that you're viewing. So that's my preference there. So we see some strong bullish divergences. In other words, prices on gold making lower low, while the PPO and the RSI on the weekly time frame are clearly making higher lows, i.e. Bullish or positive divergence. So this helps formulate, and has for months now, my longer term view on gold and why I am bullish going forward. Let's take a look now at some other time frame. Okay, this is a 2-day period chart, meaning every candlestick, instead of being 1-day price action, represents 2 days price action. This goes back 4 years. And I'm watching this downtrend line here, which I've highlighted. This is the current downtrend line, which I view as a very key resistance level. And we had these, well highlighted, well watched by most people. On GLD, it was about the 1450-ish area. This triple bottom support. We had the bottom back in mid and late 2013, as well as the more recent bottom in 2014. And then even before this happened, I said one of my scenarios at the time, which was my alternate scenario, but one I felt had a good chance of happening, was to see a fake out, a false breakdown. And again, this was all discussed in past videos. You can reference those. And that is exactly what happened. We had a very impulsive gap and break below, which proved to be just a single week. As you can see here, one candlestick below, and prices went back up and have regained that level. So all in all, I view that as very bullish price action, because that is a bear trap, a break below support, a well-watched support level that serves to do two things: draw in more new shorts, as well as flush out any weak hands in gold, and then it tends to give you a more solid base of holders of the metal. So as long as gold remains above that level, and day-to-day, even weekly gyrations or brief dips below aren't as important. You're going to see this volatility. We've had a lot of volatility in gold. The important thing is that we remain above that. I've recently pointed out this ascending broadening wedge pattern in gold when we hit the bottom of that, and so far we have moved higher. So this is, as I just talked on the weekly chart, longer term, at least bullish setup. You can't call that bullish price action because prices are at multi-year lows. However, it is set up with a potentially bullish technical pattern due to the divergences and everything else I mentioned there, the falling down to those fib support clusters. And when we look at this 2-day period, or let's just zoom in a little closer to a daily chart, this is the same trend line. We have some near-term bullish price action. Gold is making higher highs lately. Higher lows and higher highs. And once and if we take out this trend line and each of these previous reaction highs, it just further adds to the bullish case for gold. Of course, ascending, broadening wedge patterns, they can break in either direction. Inherently, they're especially leading up to a downtrend. It's an inherently bearish pattern with the majority of breakdowns. I recently quoted the stats on that. So we'll have to keep an eye on this line here, this lower trend line, because if that breaks, we're also going to take out that 1450 area I talked about. So and unless that happens, I remain near-term bullish on gold. I'll still use the word cautiously bullish because this is one big trading range. This is a battle between the bulls and the bears, and it is yet to be resolved. So until we see this trend line taken out, and let's say that there's a pretty decent resistance around the 120 all the way up to the 121-ish level. We'll still have some work to do going forward, but we'll just have to take it as it comes. Okay, a quick look. This is another view of, this is spot gold actually, a weekly chart, another long-term 10-year weekly chart on spot gold. And I have two different trend lines. This blue trend line was one I was watching for a long time, and we caught and had some very nice trades off that in 2013 on the tags of that trend line. That trend line was then broken. I do have, if you can make it out here, this black alternative trend line here that comes off looks like about the early 2006 lows. We have multiple touches on that trend line. 1, 2, 3, 4. So that's another trend line to watch. And again, we're at Fibonacci support. Strong bullish divergences on the PPO and RSI as prices make that lower low. So again, that helps formulate my longer term bullish outlook on gold. And this is the daily chart of spot gold prices. And this one, as with most of these charts I posted recently, there's a link to this chart on the home page as well as the live charts page on right side of the chart. This is the scenario I talked about. Notes are on the chart, so I won't spend too much time. There's that flush out move below that key on spot gold. It's about 1180 is that key support, that former triple bottom support. So there's a flush out bear trap move highlighted. And back here, just about a month ago, when prices were up here, I mentioned my preferred scenario to see this potential inverse head and shoulders pattern. Inverse head and shoulders are reversal patterns. They come at the bottom of downtrends. And we have a nice left shoulder here. There's the head. And at the point we were at the top of what I anticipated may form to be a right shoulder if we pulled back down to that 1180-ish area. And so far that's exactly what has happened. We pulled down, found support, moved back up. Now we still have some work to do. What I like about this pattern is not only will prices, if they continue to move up to this 1225-ish area, will they make it back up to the neckline of that pretty symmetrical inverse head and shoulders pattern, but they'll also intersect with this key downtrend line support. So a breakout above that level, a solid breakout above that level, will take us both above the inverse head and shoulders pattern as well as downtrend line support. And in my book, that's about as bullish as you can get. It's not uncommon. In fact, it is fairly common to see a back test. Once a head and shoulders pattern breaks out, we may come back to back test the neckline. We could even come back to back test this downtrend line. or gold can explode higher. It all depends on what the dollar is going to do. But either way, that's what I'm watching as of now. Yes, I'm talking about mainly the bullish scenarios because that's what is my primary forecast. But as I mentioned, if we take out these recent lows that were put here back in November, obviously that's going to be a bearish event. It's going to negate everything I've talked about here on these pattern formations, the ascending broadening wedge, the inverse head and shoulders, etc. And here's a quick look at silver, the silver ETF SLV. This is a daily chart. I believe there's also a live link to this chart, and I posted this as a trade idea recently. Mentioned the similar to gold, we have that ascending broadening wedge pattern defined by these black trend lines here and here. Mentioned it as a although that the fact that the prices leading up to this pattern were downward, which favored a downside break. It's also a very objective trade in the fact if you go long on the bottom of these patterns, your stop is just below. That gives you a very good risk-reward profile. In other words, minimum downside if you're stopped out. But if you are right and this pattern plays out to the upside, then your upside potential is quite large on this trade. So that's silver. We had this blue downtrend line. We took it out, came back down below it, but we're back up there above there again. This red and green line represents horizontal support or now resistance. There's my first price target, second price target, and the rough percentage gains to those price targets from this level, from that $16 level. So I'm waiting for a breakout above 16, for the next long entry on silver. Spot silver, or I'm sorry, this is silver, the ETF, my bad. And just to clarify, the break that I'm looking for to give it a little bit of margin of error, as are in the notes here, I'd like to see silver get above 1605 to the 1609 area just to be safe, give it a little bit of margin of error. This is a weekly chart of platinum, gold, silver, mining stocks, as well as platinum, all precious metals I'm longer term bullish on. I don't believe I've posted this chart. This is one I've been following for a while. Let's just take a look. These horizontal blue dashed lines, what I'm looking at here are the oversold levels. Now to begin with, we're looking at, I believe, what is this, this is maybe a 20-year weekly chart. Hold on one second. Yes, 20-year weekly chart. So we're looking at a 20-year history of platinum. In the last 20 years, the last 2 decades, we've seen platinum oversold on the weekly RSI 14 4 times, including just most recently. And what I do here, typically oversold itself is not a buy reading. I'm sorry. Yes, correct. Oversold in itself is not a buy signal. Stocks in a downtrend can stay oversold for quite a while. What tends to be the most effective buy signal, again, if you were to use that as a standalone indicator, which I don't, I always use oversold or overbought in conjunction with other metrics and other indicators. However, what I look for is the move back above the 30 level, which is considered the oversold level. So the first line here shows when prices became oversold or crossed down below. The second line is when they went above. So if we look at this, let's just say you went long platinum, in a very simple view here. In the last 20 years, every time platinum became oversold, you waited till the RSI crossed back above 30. You would be long here, and gold platinum peaked. You would have had a little bit of a drawdown. Yes, you would have had some dead money for a couple years, but not that much. The downside was minimal. And what I just did here, I paused the video for a second just to throw on the percentage gains, because keep in mind, I'm a big proponent of using log scale settings versus linear or arithmetic scaling, especially on long-term charts and large price moves. And when you use a log scale, this might not look like much. This is what I wanted to point out, but yet, as this measurement tool shows, that was a 77.5% move from the signal from when that RSI crossed above 30 to there. So you had a bull market of nearly 80%. The next bull market, the next signal came and gave us a return. I know you can probably not make this out on YouTube unless you're looking at a very big screen. That's about 468, so call it 470% bull market. I didn't measure this one, but it would be quite substantial as well. That was the previous bull market. And now here we are with the fourth signal, and we've recently had a crossback above the 30 level on the RSI. The one thing that I will say gives me a little pause on this chart is these previous bull markets were followed by clear and sharp bear markets, sharp drops, and then prices went on to make newer highs. There's the next bear market, sharp drop. In this case, we never made a newer high. We didn't take out the previous bull market. So, although by definition, bear market is a correction of 20% or more. So these were all solid bear markets. We just never saw the highs in platinum taken out. So, one might consider this a cyclical bull market within a larger secular bear market that began at this point. I just want to kind of give both sides of this here. However, with that being said, based on the RSI, and if you look at the intervals too of these, bull and bear markets, we're right there and really do a bull market in platinum. So, and platinum's a long trade I do on the site. Okay, this is the daily. We were just looking at a 20-year weekly chart. This is a daily chart of spot platinum prices. What we have here is a nice double, almost a triple bottom. I don't know if that's an errant spike, that candlestick there, but either way, we do have a double bottom here. We had this nice bullish falling wedge pattern, double bottom, strong positive divergences in place. I really like this chart. Platinum, broke out, came back down a little below our entry. If I'm recalling from memory, I am still long platinum via the ETF PLAT, I believe. We went a little bit underwater there, and we're back to about break even. And this is my initial target up here around the 1300 level on spot plat. Okay, I stand corrected. The symbol on the ETF, the one that I went with, was PPLT. That's the physical platinum share. So there's a pattern, same story. Obviously it's going to track spot platinum pretty well. Breakout, pull back for a near back test of the wedge. Divergences persisted. We made an ever so slightly low. It was really a double bottom on spot. This is an ETF. They do their best to track. So regardless of a marginal new low, but strong divergences in place. And I reiterate my initial price target here of 124.19. To bring us up to about this level. And keep in mind, the targets that I set are typically on longs just slightly below the actual resistance level, and that I do that to help assure a fill in case the stock were to reverse just shy of resistance. Okay, now let's move into commodities in general. This is a chart that was posted this morning on the site, simply showing the correlation between commodities and the stock market. So what I used up top, the Dow Jones USB Commodity Index, which is, there's the it's a well-diversified commodity index, not overly heavy in any really one sector, about a third agriculture and energy, and then it has some industrial and precious metals and livestock. And this is a stock market as measured by the S&P 500. So as you can see, I went back. This is a 14-year chart. That index, I only have about, I think, a 14, 15-year history on the Dow Jones USB Commodities Index. Excuse me, having trouble talking today. But as you can see, the correlation, it's almost one-to-one, very, very tight correlation historically. And, these, with the distortions of all the Fed intervention, easy money policies, a strong dollar, we've had what turned from, a highly correlated relationship to almost a one-to-one negatively inversely correlated index. So we've had just a huge correction, as most of us know, in commodities. It's also worth noting we're coming up to that previous low where we fell down during the financial collapse in early 2009. Commodities are, as a whole, are extremely overbought. And equities, of course, are very oversold. So my expectation, again, going forward into 2015, is to see, outperformance in commodities and underperformance in equities. Again, that doesn't necessarily mean the market has to crash or go down in 2015. Although I think the odds are good that we end the year negative. But even if the market's up, I would expect commodities to be up more. And before I move on, I wanted to talk about one quick thing on that, and that is confirmation bias. Confirmation bias, if you're not familiar with the term, look it up. But it is one of the most dangerous things in trading. So for those of you new to trading and you've been trading for years, you're probably aware of this. Confirmation bias is when you look at a chart or you already have an opinion on something, where the market's going to go, what this stock is going to do. You tend to look at everything through a prism that reinforces your current beliefs. And I want you to know, in trading, and it's something I struggle with every day, and I don't think there's anybody out there that doesn't suffer from it to at least some degree or another. In trading, we have to make a stance, and I work very hard on this site to formulate an opinion and then build a case for it. But keep in mind that I am flexible, and if something changes, something in the chart, something fundamentally, and my view differs, I will communicate those thoughts. So maybe mid-year, 3 months from now, half a year, I might be bearish and think commodities are going to end the year down and equities might have another strong year. That's very possible. So I try to stay flexible. This is, it's early 15. I want to give my views now because this goes into what type of trade ideas are coming out on the site, how I'm positioned both as a trader and a longer term investor. But other than ignoring your stops, there's a few ways to really perform poorly as a trader or an investor, and that is to ignore the use of stops, not use prudent diversification. In other words, here is a commodity index. You can buy this ETF. Let's say you were to put your money into this ETF, and then you also had half your portfolio in gold and silver. Well, keep in mind that this commodities index, and there is an ETF that tracks it, already has 15% of the money in precious metals. So you always take into account, if you're trading ETFs, if you have mutual funds in your portfolio, be careful not to overlap. So besides diversification, ignoring stops, and position management, meaning using too large a position size or too much leverage, the other big no-no in trading, in my opinion, is confirmation bias. So, stay flexible, stay open to other opinions, constantly review your analysis, and if the charts, or fundamentals, and or both convince you that you're wrong, you need to pull the plug and change your views. Okay, so I mentioned that for 2015, at least the foreseeable future, I favor commodities over equities in general, and again, that's generally speaking. And I want to make that clear, and I'll talk on that a little bit. Nor have I been bullish on all commodities. I've not recommended or put any general commodity ETFs on the site. I've looked at specific ones, which we'll talk on in a minute, like wheat, corn, soybeans, and some others. But there's other commodities I've been bearish on. So it's been by far and wide a stock picker's market when it comes to commodities. Commodities as a whole have been in a downtrend, but we've had some very nice and profitable trades on select commodities recently. So that's something to keep in mind. Now, with that being said, going forward, once we finally see a reversal of the dollar cannot continue at this same ascent rate that it's been doing. Once we see the dollar moderate, or for whatever reason, I'm seeing a lot of commodities, including the precious metals, start to ignore the higher dollar and moving up in spite of the dollar going up. And that, to me, speaks loudly. It's pretty bullish, especially to see that trend continue. So this is one trade idea for a longer-term investor, even a trader. This is CRBQ. It's a commodities equity ETF that doesn't hold actual commodities. This holds producers and distribution companies. This is a quick look. You can Google the CRBQ and get to the company's fact sheet. This is just a list of the holdings. You get an idea. Companies like Monsanto, ExxonMobil, Archer Daniels, John Deere. There's a whole list of those. So take a look at that. That's a play if you want equity exposure for the companies that produce and distribute the commodities. And going back to the chart, what I'm noting here, nice, strong, positive divergences as prices make a lower low. We have this previous reaction low here back in October or so, and a more recent reaction low against the MACD and the PPO, the RSI making a higher high. So positive divergence there. A little bit of a sloppy trend line. This is a relatively thinly traded ETF, so price movements can be a little erratic, but either way, this one looks like it has some promise going forward for 2015. And here's another commodities exchange traded product. This is the BCX, BlackRock Resources and Commodities Strategic Trust. Again, very strong positive divergence. And also note what I'm seeing on quite a few of these commodities or the commodity tracking ETFs if you'll note these volume patterns. Let's take a quick look at that and try to highlight that a little bit better here. Let's see. If you look at the volume bars right here, that shows capitulation. You see prices coming down in a strong downtrend, and all of a sudden this big volume surge. That is, typically what we look at as seller exhaustion, capitulation, where the last of the weak-handed longs throw in the towel. You have some new longs step in. I talk about that often. Let's just take a look. We'll look at the SPY, for example. Look at the price action. This is a 10-year weekly chart. So here's the 2009. There's a 2008 meltdown, and what do you see? A big volume surge heading into the lows. Again, it's not exaggerating here. You can take a look. And then during this entire bull market, which we're now 6 years into, off the March 2009 lows, we had one major correction. In fact, it was, by definition, I believe in the NASDAQ, a drop of over 20%. We fell just under that. I think it was like 18% or so on the SPY. Huge sell-off back in 2011, most of you remember. And then you look at this. You see the huge buying surge. That's capitulation. So that's what I'm seeing on a lot of the commodities here. And I just wanted to use the SPY as an example for that. Here's another idea, especially for longer-term investors that want to add some commodity exposure to your portfolio, DBC. This is another commodity index tracking ETF. This one's quite heavy on energy. I think it's about half or so energy and energy-related components. But if you look here again, huge volume surge. After this tremendous drop-off, looks like capitulation selling. There's a big gap to be filled at some point. Let me flip back to the price scale here. Okay, there we go. We're at 1763 right now on that, and at some point in 2015, and my guess would be the first, if not by the end of the second quarter, we'll probably see at the very least prices come to back test this gap, and that would be quite the move. That would, in percentage terms, looking to the left here on the chart, that's about an 18% move from current levels. Weekly chart. This is a 10-year weekly chart of the DBC. We had this very large symmetrical triangle pattern that's been forming since all the way back from 2010. Simple technical analysis, if you take the distance of a triangle pattern, the widest distance that is, which I've done here, I duplicated this line and added it to where the pattern breaks down. So this is your measured move. We've now exceeded the measured move, which would have brought prices down to about the 1850-ish level on DBC. Not only that, so we're right at or just slightly below the measured move. We're also down to the previous reaction low, which is a support level, the early 2009 lows in DBC. Not to mention, as is a common theme, extremely oversold. I mean, oversold levels that I don't think, at least not in recent history, and we're talking decades back, have we ever seen, commodities reach such an extreme oversold level? We're at 8.85 on the RSI. Anything below 30 is considered oversold. So, again, DBC has fully met and slightly exceeded its pattern projection at support and extremely oversold. So, again, one of, I think a good idea, or at least one potential candidate for a long-term hold for 2015, especially for those of you who are top-heavy in equities, sticking with the trend, but are a little concerned, don't want to take out of your positions, but would like to add some diversity to your portfolio. This might be another option. Okay, and to wrap this video up, just going to go through a quick bit of the good, bad, and the ugly. I talked about how so far in the last few months it has been a stock pickers market, or I should say commodities pickers market, as the general commodity indices have been falling, as I just pointed out. There have been a few, diamonds in the rough. Those have been some trade ideas on the site, things I've been highlighting. Wheat, for example. Remember, the U.S. dollar right now has been going parabolic and is at all-time highs. Typically, commodities have an inverse correlation with the dollar. Where the dollar goes up, they go down. However, certain commodities, especially the soft commodities, such as wheat here, bottomed back in October, recently hit the second target. I think I put an update on here pointing out this uptrend line and a break below that. So we've now fallen back below that in T1. So, for the most part, profits should have been booked on this. I think over time, I don't expect wheat to go on to make new lows. If you're a longer-term investor, I do think over time this third target will be hit. But we've gotten quite extended and made some nice gains on wheat. So that's one that again has bucked the trend, been doing well, and longer term bodes well. Although we might have a little more downside in the near term. This is CORN, the ETF that tracks corn. That was another trade idea, a nice bullish falling wedge. Also, early October started bucking the trend and has moved up. That was a nice long side trade as well. Bullish divergences at the lows. But again, hit a target. There's a nice thin zone there, so probably has a little work to do. But over time, I do expect this is the next target or resistance zone. I think corn will work its way up there. So that's been another bullish as of late commodity in a bullish uptrend. And this is the weekly chart of spot corn prices. I believe this was posted recently. If I didn't post it, the chart was updated on the live chart links. Back a few days ago, I mentioned that corn had made a nice run off the lows, but it was up against this downtrend line resistance here. So what we're looking at here, there's bullish divergence. That's sort of a descending channel, almost a wedge type pattern. But being that corn is at resistance and turning down, that's a good opportunity to book some profits and then wait for that trend line to be taken out before the next long entry or add-on. This is soybeans, the actual spot soybean prices. I recommend it, or shouldn't say recommend, I don't make recommendations, suggested or personally use the SOYB as a trading vehicle. It's the ETF that tracks soybean prices. You could trade futures on these too if you want. This one, but on SOYB, the ETF so thinly traded, I prefer to use the chart of spot soybean prices for my entries and exits. So we had this bullish falling wedge, divergent low, just clean technical analysis, breakout, backtest, hit the first target. We went on to hit the second target for a 13% gain. And as you'll notice on a lot of the trades on the right side of the chart, when we hit these targets, you have a reaction. A reaction is either a pause or a consolidation or a pullback, and that's what we've had here. So this one, if you look at the price action, since we took out the first target, hit the second target, prices have been trading between that resistance and support level. Remember, former resistance, which was the T1 level, once broken becomes support. And we have this one downtrend line here. I'm not crazy about that dash downtrend line because we only have 1, 2, 3. Well, we had 4 touches of break, and then we pulled back through. I'm more concerned about seeing prices punch up, make a solid break and or weekly close above this T2 level. My third target was that downtrend line. Had we continued up, that's where that would have been the final target. And technically it is because now it's hit. So this trade, I believe it's been taken off. But over time, I fully expect prices to continue to move higher, and this would be the next longer-term target area, about the 170-ish level, and then possibly, if we get through there, 1225-ish. So once again, nice bullish technical pattern, another example of how even with commodities in free fall, all commodities are not created equal. There's a lot of diversity amongst different commodity types. Okay, that was the good in commodities, and just 2 quick examples of the bad and the ugly, and then we're done. So this is the Dow Jones U.S. Aluminum Index. This is an example of the bad and the ugly. This is an actual trade we did couple months back on. I used Alcoa aluminum as a play. Um, on because Alcoa aluminum tracks aluminum prices almost directly. This was the chart I put up at the time. You can reference the post. I'll take a look at the AA chart in a minute, but this one was pretty straightforward. We're looking at, goodness, I think a 10 plus year weekly chart here, and in that time we've only experienced 3 overbought readings. The most recent extremely overbought, much more than the other two. And if you look at the red arrows, you can see what price did on these relatively brief overbought readings. We had this huge bear market here, this huge correction. Once again, remember, these are log scales, so if you do the math on a drop from 150 down to $50 or so, well, that's pretty significant drop. So what we did here on that next, we had prices coming up to this resistance level that I had marked, extremely overbought. We had a trend line break, and so what that led to was a short on Alcoa aluminum, and that was a weekly chart. I always use the daily charts to kind of zoom in and help time the entries and exits. So this was the trade that we did here on the site and closed out a couple months ago. Well, there's the notes back in mid-October. Nice breakdown. That was when aluminum prices hit that level. AA happened to break the trend line as well, came down, hit that second target for a quick 1 month 15.5% gain. So there's an example of you can be bullish on one commodity, bearish on another, because they wheat and aluminum for the most part have nothing to do with each other. And again, that is why up until this point I have not been a big proponent or recommending or suggesting any of the general commodities ETFs, although I do believe at this time, for especially longer term investors, that they are looking good. Especially for those that, longer term investors, less active traders that don't have the time to actively manage their portfolio and want to add some exposure. Some of the broader commodity ETFs I mentioned a minute ago, I think might make sense, at least to begin to scale in here, start taking some positions for 2015. And the final chart, and we'll wrap this up. This is just another case of the good, bad, the ugly. This is one that I've been following. Chose not to put it on as a short idea, but another example of how some of the commodities had clear bearish charts in the last few months. This is the Dow Jones U.S. live cattle subindex. So we see, up here, this is the primary uptrend line. We've been bouncing along. So the cattle has been in a more of a secular or primary bull market, but within that, leading up to the last few months, we had this bearish rising wedge pattern, strong negative divergences in place below. Prices broke down, and there was a very sharp correction. We hit that trend line and bounced, but again, while wheat, corn, and other things were going up, which would make sense. That's a cost for the farmers to feed their cow. So you see wheat and corn prices going up, or the grains, I should say. Typically, that's going to take a bite into the profits of the cattle farmers. So this has been Randy Finney with the right side of the chart. Hope you enjoyed it.